This is Group Three's presentation on American Airlines, and in this presentation, we're going to examine the current state of American Airlines, compare that to the state of the economy, talk about some incoming changes, future outlook of American Airlines. We chose to focus on American Airlines because the topic of airline travel is always top of mind in the business world, as the airline industry still continues to recover from the COVID pandemic. Additionally, American Airlines operates in a highly competitive industry, making them a really interesting case for strategic management. American Airlines is a publicly traded company that operates a diverse fleet of aircrafts. Their main revenue generator is business and leisure travelers, as well as cargo revenues. They operate on the NASDAQ under the AAL stock ticker. They are headquartered in Dallas, Fort Worth, Texas, founded in 1926 with Robert Isom as the CEO. And we will examine the CEO's pay in a further slide. Their full year revenue was $54.2 billion for 2024. Some recent acquisitions are U.S. Airways, Trans World Airlines, and Reno Air. And their most recent partnership is with Citi to expand their exclusive AA Awards program for travelers. We examine the CEO pay of Robert Isom of American Airlines, as well as the CEOs of Delta and JetBlue Airlines. You can see the big jump in Robert Isom's pay from 2022 to 2023. This is mainly due to total compensation, including incentives and stock awards. As we learned this semester, CEO pay can be influenced by many factors, including company profitability, compensation structure, leadership experience, and retaining top talent. Unfortunately for American Airlines, the company has seen a decline over the years. And it is interesting that even with the recent decline, the company continues to keep or raise the CEO salary. With an incentive-based salary at the top of a base salary, we believe the company should revamp the CEO salary, and the company should invest into needed areas to help regain market share.
All right, so for this slide, I'm going to be looking at the state of the company. When looking over American Airlines' recent financial statements, it is clear that the company is having some trouble. In the past 3 years, the company has seen a recent decline. Multiple factors have negatively impacted the company, such as failed pricing strategy, poor forecasting, the economy reward/loyalty programs, and corporate flight strategy. Now, when looking at this list, the most impactful issues were the corporate flight strategy, failed pricing strategy, and reward/loyalty programs. Not to neglect the other strategies as well, but those were the most important. Corporate flights generate a lot of revenue for airlines as well because companies often purchase the tickets in bulk and at its highest price. As for loyalty and rewards programs, American Airlines made a crucial mistake pulling out capital in the programs, giving competitors like Delta and United an opportunity to pull in more customers. For example, companies began investing more into Delta and United because their rewards and loyalty programs were seen to have more benefits. All right, so for this slide, we're going to be talking about the incoming changes that American Airlines has made. So to begin with, American Airlines has acknowledged a serious number of serious missteps in recent years. From operational inefficiencies to outdated IT systems and employee dissatisfaction, the company has faced a turbulent time both internally and in terms of customer perception. But there's some positive momentum. American Airlines has recently initiated a multi-pronged improvement strategy. First, operation improvements. This includes optimizing flight schedules, reducing delays, and investing in fleet upgrades to improve reliability and efficiency. Second, there's been a revamp in their loyalty program, recognizing that customer retention is key. American Airlines is making the program more rewarding and transparent, with better incentives for frequent flyers and more personalized engagement. Third, IT systems improvements are underway. American Airlines is modernizing its technology infrastructure, moving away from legacy systems and integrating more robust data analytics and real-time monitoring to enhance both customer service and operational agility. Finally, and perhaps most critically, employee benefits are being improved. This includes better healthcare options, increased training and opportunities, and more competitive compensation. The company is clearly trying to reestablish trust with its workforce and improve morale across the board. In summary, these changes signal a more strategic and employee and customer focused direction for American Airlines. Whether these efforts were enough to fully restore the airline's reputation remains to be seen, but the steps being taken are both significant and necessary.
As for valuation, we performed a discounted cash flows valuation of American Airlines. Our valuation showed us that American Airlines is extremely undervalued. After calculating from a 5-year projection, we got an intrinsic value of $47.15 per share. Intrinsic values like the perceived or projected value of a stock. And that's what we got from our valuation. And the price per share at the time of our valuation was $11.40, showing that American Airlines is extremely undervalued. Did a little research on the side after we did our discounted cash flows valuation, and a lot of analysts suggest that American Airlines undervalued as well. One saying by at least 77%, with somewhat similar intrinsic value to ours of $44 per share. The stock being undervalued right now could be due to external environmental factors and other factors in the industry, with a lot of crashes happening recently and issues with Boeing. As for cost of capital, American Airlines' weighted average cost of capital is right around 7%. The weighted average cost of capital basically shows how much money a company needs to make from an investment in order to benefit their shareholders. So American Airlines, if they were going to decide to buy a new airplane, they'd have to determine that that airplane would, make them at least 7% to not negatively affect their shareholders. So calculated this using equity times equity weight plus cost of debt times debt weight. And this shows that American Airlines is in a good financial position based on industry levels. The airline industry is a little more high risk and requires a bit more cost of capital, so this is actually pretty good for the industry. American Airlines would use this to determine whether they have sufficient funds for fleet upgrades, along with making or helping them make the best decisions for their investors, as I already touched on.
Now let's take a look at the future outlook for American Airlines and how it's approaching strategy post-COVID. One of the key elements here relates to investment strategy, specifically passive versus active management. After the pandemic, American Airlines leaned heavily into an active strategy, trying to outmaneuver its competitors through aggressive decisions. Unfortunately, this approach didn't pan out as expected. Instead of gaining leverage, the company saw its stock value drop and lost market share. This highlights a core concept we've discussed in class. While active strategies can offer potential upsides, they can also carry higher risk, especially in volatile industries like air travel. Looking forward, one of the largest looming concerns for American Airlines is tariffs, particularly on the aircraft parts. This could significantly impact their cost structure. In response, the airline is taking a proactive approach. They've begun lobbying political leaders to push back on these potential tariffs, not just to protect their bottom line, but also to shield consumers from rising ticket prices. Operationally, American Airlines has already started cutting costs in anticipation, but they acknowledge that the most vulnerable area is parts sourcing. If tariffs do take effect, we can expect several potential consequences. An increase in prices, but both for the airlines and passengers, a reduction in travel demand, especially on price-sensitive routes, a greater financial uncertainty, which can affect investor confidence. Flight cuts and booking slowdowns, particularly on less profitable routes. So while American Airlines is making adjustments, its ability to navigate these external threats will heavily influence its long-term stability and success. It's a delicate balance between policy, cost management, and customer retention. We thank you for taking the time to listen to this presentation.